What's up, guys? In this video, I'm going to explain why you may rethink having your limited liability company taxed as an S-Corporation. This is an important topic for any business owner because any one of the 7 issues I will be covering can have major negative tax ramifications if you make a mistake. Now, if you want to learn more about how to properly structure all your real estate investments in your business, you can register for our free tax and asset protection live event at the link below. All right, now let's dive into some of the rules that can trip you up and force you to pay a tax liability in making an S election for your LLC. Here's the first problem that I run into time and time again: your operating agreement. You know, most LLC operating agreements are set up to be treated as partnership taxation. That is, when you read the operating agreement, it has provisions in there for partnerships under the tax code. Now, this is a problem if you elect to treat your LLC as an S-Corporation. Your operating agreement needs to match the right tax provisions, because if it doesn't, if you have partnership provisions in there, then what you're allowed to effectively do is have 2 classes of interest in your limited liability company. And this is a problem. An S-Corporation can only have 1 class of interest. So if I have an LLC and my operating agreement states that it has partnership provisions inside of it when I read through their tax provisions, which apply to having 2 classes of interest, but I elected to treat my LLC as an S-Corp and I get audited, the IRS will look at that and they'll say that this LLC that's treated as an S-Corp has 2 classes of interest. The S-Corporation election is invalid. They'll convert it to a C-Corp, and then there'll be taxes and penalties associated with that. So that is the first mistake we have. All right, the second issue that you have when it comes to making an S election on an LLC has to do with if you have existing assets inside of your company. If you have an LLC that's been set up and maybe you've been running it as a partnership or disregarded entity, and you talk to a CPA and they say, hey, we can save you some money here if you make an S election on tax on your LLC to treat as an S corporation, be careful. If you have assets inside of that LLC where the adjusted tax basis of those assets is less than the liabilities that the corporation is taking on that it currently has with respect to that asset, you can be taxed on that difference. So let's say I had an asset where I've depreciated it all down to nothing. It has $50,000 in debt on it. My basis is less than the debt. My LLC is liable for that debt. I make an election to treat it as an S corporation, 50 grand is going to be triggered, and I'll have to pay tax on that. So you need to be careful whenever you make that election. The third issue that comes up is that in a limited liability company, you can have gain on the transfers of assets to an LLC. So this is a real issue if you have multiple partners. If it's just you, it's not a problem. But if I have an asset that I'm moving into a limited liability company that is appreciated in value, or it's higher than my tax basis, and I don't own at least 80% of that company after I make the transfer into the LLC, then I will have to pay tax on that difference. So in situations where there are multiple partners, be careful before you make this election to treat your LLC as an S corporation, because it could prove taxable for some of the partners. Because not only is it about moving assets in, it comes down to this. Let's say that we have 3 partners. One of them has 80% and the other 2 have 10% each, and they've all contributed assets to the LLC. We decide as partners to convert that LLC to treat it as an S corporation for federal tax purposes. Well, 2 of those partners, from a tax standpoint, they're going to be treated as taking their assets out and recontributing them. That's how you get nailed when you convert your LLC to an S corporation. Now, the fourth issue we have is allocating income or losses based on anything other than ownership. So when you convert your LLC to be treated as an S corporation, if you have provisions in there, let's say allocated income to one partner, say there was a waterfall. For example, I was working with 2 individuals and one of them was going to spend a lot of the time on developing out these websites, where the other one was just putting in management experience and capital to get the business going. And he said to me, hey, what I'd like to do is set up the company where the guy that's doing all the web development, he gets paid the first 20% of the income that it comes in, and then the remaining portion gets split between the 2 of us. That works if your LLC is treated as a partnership. You can do that, or a C corporation. But if you treat it as an S corporation, or you make an election, to convert it to an S corp, that will blow up your election right then and there, because you cannot allocate income or losses based on anything other than ownership. If you're both 50-50, then it has to be split 50-50, and you can't give this preferential treatment to one of the partners. The fifth reason you should be leery of converting your LLC to converting it to an S corporation is you don't get a basis increase for debt. So what do I mean by that? When I have a partnership that I've set up and I put in transfer an asset into that partnership, if there's $100,000 in debt on that asset, I get a tax basis for $100,000, meaning I could refinance the property, pull $100,000 out, and I wouldn't have to pay tax on that money because it's a partnership, and Section 721 of the code states that you get basis for any debt on the property. With your S corporation, you don't get basis for debt. So in that example that I just provided to you, if you have an asset inside of your S corporation and you go out and you get a loan against that asset and you distribute that money out to you, there's a good chance that that distribution will be taxable to you. So when you're making the selection, you got to look at the assets themselves as well and think about, hey, do I intend to mortgage them or do anything like that or leverage them? Do that before you make the election. A lot of times I tell people with all these rules, pull the assets out. If it's a partnership, before you make the election, get the assets out, then think about how to put them back in after the fact so you can avoid some of this. The sixth issue you have, distribution of appreciated property is taxable to a member. So if I convert my LLC to be treated as an S corporation, I decide 3 years later to pull an asset out of that company because I want to do a refi, and they tell me you can only do the refi in your own name, or you just want to get it out because there's too many assets inside of there. When you pull that asset out of an LLC that's treated as an S corp, that's taxable to you. That means if the basis in the asset was $100K, its value today is $500,000, $400,000 you'll consider to have earned when you pull that money out. It's treated as a deemed sale. That's another problem with S corporation taxation on limited liability companies. Now, the last problem we have with limited liability companies is that they're being S corporations is there's no step up in basis rule if you buy out a partner. Meaning that if I buy out one of my partners in my business entity, I don't get to increase my overall tax basis in the limited liability company because the S corporation rules prevent that. Whereas if it was a partnership, I can increase my tax basis. So in the future, when I start pulling out the money that's retained in there, I don't have to pay tax on it. Those are 7 of the main problems for people who convert an existing LLC into an S corporation that you need to be aware of before you go out there and make that conversion. Hey, if you want to learn more, I'd like to invite you to our tax and asset protection event. You can click on the link below to register for this event. At this event, we're going to teach you all about setting up the right types of business entities for your real estate investing, for your small businesses, where we cover LLCs, land trusts, corporations, and not only go deep into the business entities and how you apply them to your investing, we also talk about the tax strategies surrounding them. You'll get in-depth information on tax planning and the multitude of different benefits that you should be taking advantage of here in 2023 to reduce your taxes so you don't pay more of what you've earned.